Okay, today we are going to discuss about financial derivatives. So, what actually this derivative means? The term derivative refers to a type of financial contract whose value is dependent on an underlying asset, or it may be a group of asset. So, a derivative is a set between two or more parties that can trade on an exchange or an OTC. So, derivative is a contract which derives its value from an underlying asset. That is what we call it as a financial derivatives. So, it is a financial instrument which derives its value from an underlying asset. So, we can say that derivatives are a financial contract set between two or more parties that derives their value from an underlying asset or group of asset or a benchmark. Derivatives can be traded on an exchange or on the over the counter. So price for derivatives derives from the fluctuations in the underlying asset. So derivatives are usually uh, leveraged instruments which increases their potential risks and rewards. So common derivatives, it includes future contract, forward contract, options and swaps. So let us consider an example. Uh, let us uh, let us say that there is a farmer. We have a farmer who's having a cornfield, and it will be harvested in 3 months. It's going to be harvested in 3 months. But he is unsure about the price he will receive at that time. That is, after 3 months, what price he is going to receive. He is not sure about it. Will he get a buyer when he is in the market to sell the corn 3 months later? So it is uncertain. After 3 months, what will happen to his corn? It is uncertain. After 3 months, what will happen to his corn is uncertain. So a derivatives is a contract which will enable him to enter into a firm contract today to sell a fixed quantity of corn of an agreed upon quality at a mutually agreed price at the time specified. So in this case, the time specified will be after 3 months. So here, the farmer now knows how much demand there is for his corn for delivery after 3 months when he is ready with this harvest. And he also knows what price he will receive for his produce after 3 months. So at that time, this the financial derivative, it removes the uncertainty. Is removed. So another example, we can take an IT company which is going to receive its payment in US dollar a month later. It is unsure about the value of this receipt. So, being I'm in India, let me take it is unsure about the rupee value of this receipt at the time. After 1 month, what is going to be the value of rupee for dollars? I'm unsure. Today it is 80 rupees. 1 month back it was 74 rupees. So after 1 month, what will be the value? Will it increase or will it decrease? I'm not sure. So derivative can enable this company to sell the receivables in US dollar today to lock into the prevailing US Indian rupee rate for 1 month. So whatever may be the change, it is they will not bother. So what is the rate today? It is locked for 1 month. So here also the company has mitigated the uncertainty. It has an assured buyer for the revenue flow in US dollar. It is assured of an exchange rate today to enable a sound planning. So these derivatives are used for these financial derivatives are used for first one, speculation. So a speculator is one who bets on a price movement in his favor. In effect, speculators use derivatives as a tool of leverage to enhance return or to lose more money if they are proved wrong. So, financial derivatives are used for speculation. Second thing, it is used as arbitrage. So, an arbitrager takes an advantage of a price differential in two markets for the same assets at the same time. So he or she makes a riskless profit by buying the asset in a market with a lower price while simultaneously selling it in the market with a higher price. They are called as arbitrages. So financial derivatives are used for arbitrage. Third, hedging. So a hedger either owns the asset or the right to the asset, or he is a consumer of the asset or a prospective consumer of the asset. So hedger uses futures and option market to reduce their risk. A perfect hedging is would be one which eliminates risk entirely. So here, this example of farmer can be taken. For example, if he feels that after 3 months the corn price is going to fall down, then he will get into a contract with the person on today's date to sell a contract at the price in which it is sold today. That is called as hedging. So these are the three uses of derivatives. The first one is speculation, second one is arbitrage, and third one is hedging. these financial derivatives have got some features. So features of financial derivatives. So the first feature is it is a contract. It is a contract. So derivatives is a future contract between two parties. It means that must be a contract binding on the underlying parties and the same to be fulfilled in the future. The future period may be a short or a long depending upon the nature of the contract. For example, short-term interest rate futures and long-term interest rate futures contract are there. So it is a contract between two parties to settle the fulfillment in the future period. So financial derivatives is a contract. Second, it derives the value from an underlying asset. So normally the derivative is an instrument. How the value is derived from an underlying asset. For example, agricultural commodities, metal, financial assets, intangible assets, etc. So the value of derivatives is actually the derivatives are a document. It doesn't have any value. The value for that derivatives comes from an underlying asset. So the value of derivatives depends upon the value of an underlying instrument and which changes as per the change in the underlying assets. And sometimes it may be nil or zero, hence they are closely related. So derivatives is a document which doesn't have a value, but the value for the derivatives comes from an underlying asset. Third, specified obligation. In general, the counterparties have a specified obligation under the derivatives contract. The nature of the obligation would be different as per the types of the instrument of the derivatives. For example, the obligation of the counterparties under the different derivatives such as forward contract, future contract, option contract, and swap contract would be different. So each type of contract have its own type of obligation, which has to be settled in a specified time. Uh, Annie, I think your video is on. Annie, Annie, I think your video is on. Annie, is it on? Your video is on. Annie, next the fourth one, direct or exchange traded. So the derivatives contract can be undertaken directly between two parties or through a particular exchange, like financial futures contract. The exchange traded derivatives are quite easily liquidable and have low transaction cost in comparison to the tailor-made contract. So forwards contract or tailor-made contract, which is not traded in exchange. Fifth one is related to notional amount. Uh, in general, the financial derivatives are carried off balance sheet. The size of the derivatives contract depends upon its notional amount. The notional amount is the amount used to calculate the payoff. For instance, uh, in the options contract, the potential loss and potential payoff both may be different from the value of the underlying share, because the payoff of derivative product differs from the payoff of that their notional amount might suggest. So while going through the chapters of options, you can understand that. Sixth point: delivering of underlying asset not involved. Usually in derivatives trading, the making of delivery of underlying asset is not involved. Rather than underlying transactions are mostly settled by taking offsetting positions in the derivatives themselves. So there is therefore no effective limit of quantity of clients which can be traded in respect of underlying asset. So next, derivatives are usually a secondary market instruments. So derivatives are mostly secondary market instruments, and they have a little usefulness in mobilizing a fresh capital by the corporate world. However, the warrants and convertibles are exception in this respect. Exposure to risk. Although in the market, the standardized general and exchange traded derivatives are being increasingly evolved. However, still there are so many privately negotiated, customized OTC, that is over the counter traded derivatives, are in existence. They expose the trading parties to operational risk, counterparty risk, and legal risk. Further, there may also be uncertainty about the regulatory status of such derivatives. So, these are the features of financial derivatives. So, it is a contract between two parties. Derivatives take their value from an underlying asset. They have a specified obligation. Whenever a contract is entered, they have a specified obligation on a specified date. Sometimes it is directly traded. In some cases, it is customized and directly traded. And in other cases, it is traded only in exchanges. And it relates to an notional amount, and delivering of the underlying asset is not involved in derivatives contract. It is considered as an secondary market instrument, and it has got exposure to risk. In some cases, it is not traded in exchange. Since it is not traded in exchange, it is easily customizable, and there is a chance for operational risk, counterparty risk, and legal risk. So, when it comes to derivatives, we have two types of derivatives. One is financial derivative, another one is a commodity derivative. So, in financial derivatives, we have basic and complex. So, basic, we have forward, futures, options, and warrants and convertibles. In complex one, we have two things. One is swaps and exotics. So, in your syllabus, we will be learning what is forward contract, what is future contract, and what is options, and you will be learning what is swaps. And in last unit, you will be having commodity trading. So these are the types of derivatives. Derivatives, it is of two types. One is financial derivative, and another one is a commodity derivative. Financial derivatives, we splitting it upon two types. One is basic, and another one is complex. In basic, we have four types: forwards, futures, options, and warrants and convertible. In complex, we have two types. One is swaps, and another one is exotics. So, having gone through this, let us now venture into the types of derivatives. So, we have four types of derivatives to discuss with. First one is futures, second options, forwards, and then swaps. So to start with, let us start discussing with forwards. The first one is forwards. A forward contract is a contract between two parties, either on one basis, and it is usually transacted in an over the counter exchanges. So it is not regularized. So you can customize over the counter exchanges. So it has got binding on both the parties. Completed with one buyer and one seller, specific in terms of price of the underlying to be exchanged, the quality, type, and the underlying, the date of delivery, the quantity, and where applicable, the place and the mode of delivery. So, a customized contract wherein both the parties to the contract must be consensus. So, for example, let us take, if A agrees to purchase 100 grams of wheat from B at rupees 40 per kg after 6 months, it is a forward contract. So, A agrees to purchase 100 kgs of wheat at 40 per kg from B after 6 months. It is a forward contract. Here you can see that the quality, specifications, delivery terms are all clearly specified in the contract. A is assured of a buyer of 100 kgs at 40 per kg 6 months from now. B is assured of supply of 100 kgs at 40 per kg 6 months from now. So this is what we call it as win-win situation. Yeah, but there is a counterparty risk in forward contract. So counterparty risk is the risk of default by one of the party. So here you have two parties, A and B. This contract is not in an exchange. It is an OTC contract. So here we have counterparty risk. Either A or B may default. So A gives a guarantee that after 6 months he will deliver 100 kgs at 40 per kg to B. B is expected to receive 100 kgs at rupees 40 per kg after 6 months. So this is not traded in an exchange. The contract is not regulated contract. So there is a chance for a counterparty risk. When the price of the wheat becomes rupees 55, instead of 40, if it becomes 55, then A has every incentive to default on contract to deliver at 40. Instead of delivering it at 40, he can sell it for 55. The reverse would also hold true. The price of wheat crashes to 25, in which case B would be better off not honoring the forward contract but rather purchase the required quantity in the spot market. If it is possible that one party is not able to fulfill their commitment as per the forward contract. So here we have the counterparty risk in forwards contract. The next is a futures contract. Next one is a futures contract. Again, futures contract is a contract between two parties, but it is executed through a stock exchange, binding on both the parties, even though neither of them have a link about the identity of their of other person. In forwards contract, A knows B and B knows A, but in futures contract, A need not know who is B and B need not know who is A. There is a mediator who is called as exchange. Uh, in theoretical point of view, it is free from counterparty risk. Uh, by process, it is known as novation. The stock exchange becomes the buyer for the seller and the seller for the buyer, and it is standardized as per these exchange regulations, specific as to the price, quantity, specification, delivery date, terms, etc. So everything else remains the same as it is in forward contract, but the futures contract is standardized, and a mediator is there for futures contract, and that mediator is called as exchange. So there are certain differences between forwards and futures contracts. So the meaning, forwards contract is an agreement entered into by two parties to trade assets in future to an agreed upon rate. Whereas futures contract is an agreement where parties agree to sell a fixed asset at a fixed price in the future rate, or buy a fixed asset at a future rate. So next, the form, it's a unique contract, whereas future it is a standard contract. Whereas it is not forwards is not traded in exchange, so it is a unique. They can customize according to their needs and requirement. But in futures it is not possible. They have to follow the standard which is given by the exchange. Settlement, it is upon maturity. Forward contract, it is settled upon maturity, but futures contract anytime, even before the maturity date you can call off. Regulations, there is no self regulations for a forwards contract, but for futures contract it is regulated. Trading, forward contract, it is not uh, done in a exchange, it is over the counter, OTC. Whereas futures contract, it is in an organized stock exchange platform. And again we can say that it forwards contract is not that much easily liquidable, whereas futures contract it is easily liquidable. So in forwards contract, the contract is entire transaction is settled between the same two parties. As we see, as said, the A and B, they are the parties who are going to settle it down. Whereas in case of futures contract, stock exchange is the counterparty. Hence, both the parties deal only with the stock exchange. And in futures contract, there is an initial margin which is collected up front plus daily MTM, that is called as mark to market margin, which both the buyer and the seller have to deposit with the exchange. But whereas in forwards, nothing like that. The reason for this is to ensure that the maximum loss on trade going away, and it is limited just 1 day volatility. In all the probabilities, if the risk margin system are well formatted, this 1 day loss would be easily covered by the initial margin. Hence, the risk of default becomes negligible in futures contract. Next is options. So, an options contract is one which gives the buyer the right but not the obligation to buy or sell a contracted quantity of the underlying at a predetermined price on or before a specified date. So this is one-sided contract. Only one party seems to benefit. Hence, the buyer of the option pays to the seller or a writer an amount upfront called option premium, which I will explain it to you while covering the unit 3. The seller or otherwise called as a writer of the option has the obligation but no rights to comply with the right of the buyer or the option holder. So there are two types of option. That is, one is a call option and another one is a put option. The call option gives the buyer the right without obligation to purchase the underlying asset. Put option gives the buyer the right without obligation to sell the underlying asset. Next is the swaps. So swap is an agreement between two counterparties to exchange cash flow on a specified date based on the terms of contract entered into. So there are several types of swap: interest swap, currency swap, and equity swap, and also we have commodity swap. So in an interest swap, the principal amount does not change, hence the interest payment or exchanged based on the notional principal. So interest rate swap do not generate new funding; they merely convert the payment of interest from the fixed to floating rate and vice versa. This method is called as plain vanilla swap. Uh, Again, we'll discuss it in the fourth unit. So these are the four types of financial derivatives. The first one is forward, which is not traded in exchange. It is sometimes between two parties. Uh, it can be customized according to their taste. Second is futures, which is traded in exchange. Then options, then swaps. Even in swaps, we have two types of swaps. There are swaps which is not traded in exchanges. It is customized and it is created according to the uh, interest of the parties. So there are certain risk which is involved in derivatives. So first one is a counterparty risk. First one is a counterparty risk. About three quarters of derivatives contract across the world are entered over the counter. This means there is no exchange involved. Hence, there is a probability that the counterparty may not be able to fulfill its obligation. So, this gives rise to the most obvious type of risk associated with the derivatives market, that is counterparty risk. As I told you, there are two persons A and B. If they are getting into a contract without any exchanges involved, so there are chances for default on the side of A or default on the side of B. So that is called as counterparty risk. The second risk is a price risk. So derivatives being traded on a securities exchange are a relatively new phenomenon. Hence, all participants, including the most seasoned one, are clueless as to what should the pricing of these derivatives be. The market is functioning in terms of superior knowledge relatively to peers. Hence, there is always a risk that the majority of market may be mispricing these derivatives and may cause large scale default. And this has already happened in famous incident, including the company called Long Term Capital Management. LTCM became part of a trillion-dollar default and became a prime example as to how even the even the smartest management may end up wrongly guessing the price of the derivatives. So that is called as price risk. Third, agency risk. So very less talked about the problem pertaining to derivatives market is that of agency risk. So agency risk simply means that if there is a principal and an agent, and the agent may not act in the best interest of the principal because their objectives are different from that of the principal. In this scenario, it would mean that if a derivative trader is acting on behalf of a multinational corporation or a bank, the interest of the organization and that of the individual employees who is authorized to make a decision may be different. This may seem like a small problem. However, if we consider what happens at companies like Procter and Gamble, then the true picture emerges. So this risk is called as agency risk. The fourth one is systemic risk. Systemic risk pertaining to the derivatives is widely spoken about. It seems to be less understood and almost never quantified. System risk refers to the probability of widespread default in all financial markets because of a default that initially started in the derivatives market. In simple words, this is the belief that because derivatives are so volatile and one major default can cause cascading default throughout the derivatives market. These cascading default will then spin out of control and enter the financial domain in general, threatening the existence of entire financial system. This view has been prevalent for a long time. However, it was often dismissed as a silly doomsday prediction. So that is what we call it as systemic risk. One default is a cascade has got a relation and a cascade relation for other default also. So these are the four types of risk in financial derivatives. One is a counterparty risk. When one of the party defaults, it is called as counterparty risk. Price risk, expecting about the future, we are fixing the price. The price will not be uh, we cannot easily justify what is going to happen in the future. We cannot, by calculation, we cannot fix up the price. So there is a chance for price risk, agency risk, and the last one is systemic risk. These are the risks which is involved in derivatives. Next, disadvantages of derivatives. High volatility. Since uh, since the value of derivatives is based on certain underlying things such as commodities, metals, stocks, etc., they are exposed to high risk. Most of the derivatives traded on open market and the price of these commodities, metals, and stocks will continuously changing in nature. So the risk that one may lose their value is very high. Second, requires expertise. So in case of mutual fund or shares, one can manage with even a limited knowledge pertaining to is sector of trading. But in case of derivatives, it is very difficult to sustain in the market without expert knowledge in the field. Third, contract life. The main problem with the derivatives contract is their limited life. As the time passes, the value of the derivatives will decline and so on. So one may even have chances of losing completely within that agreed time frame. So these are the disadvantages of derivatives. Any questions? Do you have any questions? Yes, Matthew, I'm not able to get you. Can you put it in chat box?